Hello, everyone, and welcome to Treasury Strategies webinar for this afternoon on Account Analyses, a starting point for good bank relationship management. Thanks for joining us today. My name is Kathy Gregg, and I'm a Managing Director with Treasury Strategies. I'm joined here in Chicago this afternoon by Tony Carfang, who's also a Managing Director, and we're looking forward to having a good conversation with you this afternoon about account analyses. And our focus today is thinking about how those analyses can be a good tool for you as you manage your bank relationships more effectively. Let's first of all quickly review today's agenda. We have a half-hour webinar today. We're going to talk for about 20 minutes, and then we'll save 10 minutes at the end for live Q&A. And you'll be able to, throughout the webinar, type your questions into the box at the bottom right-hand corner of your screen. And then at the 20-minute or so mark, we'll wrap up our comments and we'll start answering those questions for the whole group. Any questions we don't get to, we'll answer collectively and send the answers out to everybody who's on the call. So we'll start our discussion today with a couple of quick polling questions. So we can we're not ready to go to those yet for a second though. A couple of quick polling questions so we can take stock of where everybody is. And then we'll move into thinking, okay, what should our goals be? Why should we be bothering looking at our account analyses? And then a couple of specific areas where reviewing what's on these analyses can actually feed well into your bank relationship management activities. So your spend, your wallet and fees and ECRs and benchmarks. And then finally, at the end, we've got a little Christmas present, I should say. It's a special offer for you to be able to, at no cost, get access for a year to our new in-depth tool, which will help you do all the things that we're going to talk about this afternoon, help you do them easily and quickly and professionally. And you're going to want to stick around for that because it's a really good offer. Okay, so with that as our agenda, let's go to our first polling question. And real quickly, we just want to ask those of you on the phone, what do you do to manage your bank relationships today? Do you have a structured formal program? Is it informal? Would you categorize it as an informal assessment? Do you meet once a year or on some other sort of schedule with your banks to take stock of how the relationship's going? Or would you say you don't really do very much, it's the bank relationships sort of manage themselves? So go ahead and answer those. We'll leave the poll open for, just a quick 20 seconds here or so, and then we'll assess. Okay, so we're tabulating the responses now. When we've done this poll with other groups, what we've basically seen is that most companies are very informal and unstructured in how they manage their bank relationships. And your answers are sort of in line with that. Of the 53%, let's see, we have 53% that didn't answer. So of the group that did answer, it looks like about 40% of those say they're structured. About 15 or 16% say it's informal. Another 22% say they're meeting once a year, and 16% say they don't do very much. So basically, we have a mix of some group who is structured and the rest that don't do much or are very informal about it.
Now, Kathy, this group seems a little more structured in the process than we've seen in the past. So that's kind of fascinating, and I think a very good sign, because at Treasury Strategies we believe that managing your bank relationships in a formal way and a transparent way is the way to go.
Yeah, and good. This tool that we're talking about today and the ideas that we have for you will help support that. Okay, let's go to our second question quickly here. What do you do now to analyze your account analyses? Do you look at them carefully every month? Do you look at them if there's time? Would you say you don't do very much at all? Or maybe some of you don't even receive account analyses. Okay, we'll tabulate those. Now what we've seen well, let's just look at your answers first, and then I'll talk about previously. So a reasonable chunk of you actually analyze carefully every month, and about the same number of people collectively look if there's time, don't do very much, or don't even receive analyses. So I think you're just split sort of 50-50 on this one. In some other groups we've looked at, I would say there are fewer people who would respond analyze very carefully. So again, that's very interesting. And again, our topics today I think are going to help those of you, both of those of you who analyze carefully, and give you some food for thought if you're somebody who doesn't have very much time or doesn't do very much at all. So let's start with a kind of theoretical question. Why should you bother with these account analyses to begin with? Now, some people might say, you know what, I don't bother with them because I have excess balances at my bank or all my banks, and so since I'm excess, why should I bother checking anything? You know, everything's paid for and whatever. And then a lot of the rest of you would probably see, well, I do bother with them at some level, and what I do is I check my prices and I check my balances. And that's kind of hard to do, isn't it? It can get pretty complicated. How do you know if those prices are what they're supposed to be? And if you're not looking month to month and doing a good comparison, your balances can actually be all over the place. We say that there is a tremendous amount you can learn from looking at your account analyses every month. But the challenge is, of course, you don't want it to take forever. You don't want to have to dive into hundreds of pages of line items with service codes that are very difficult to digest, nor do you want to have to decipher tables of balances and ECRs and compensating levels that look like a math puzzle of some sort. So you want something that lets you get at this information easily and simply, so that you can spend your time thinking about what it's telling you as opposed to trying to decipher the numbers. Now, in today's environment with interest rates rising and coming out of the financial crisis, we think that there could be a lot going on, especially in 2018, with ECRs and with price levels, and now is a particularly important time to have an eye on what's going on in these analyses. All right, so let's move into some of the specifics of things that we think it's worth looking at in looking at your analyses, and one of those is your overall spend. Now, this, of course, is difficult to get your hands around when, as I said, you're looking at hundreds, sometimes hundreds of pages of line item service codes. How do you make sense of that? If you can imagine getting charts like what I've got as an example here every month, first of all, it's showing you your overall spend across all your banks, this one pie chart that's at the top of the diagram. And the first thing to ask yourself is, you know, I need to understand what I'm buying and how I'm distributing this across my bank and what position each of the banks is taking. So here I've got a diagram that's telling me I'm spending more than half of my monthly expense on yellow service, whatever yellow service is, funds transfer.
Funds transfer.
Does that make sense? I need to ask myself that. Does that make sense? And if you probably didn't remember from the previous graph, but our total spend was about $80,000. So that says every month I'm spending better than $40,000 on funds transfer. does that make sense for the kind of business my company does? You know, if I'm a title company, I'm sure I do spend a lot of money on funds transfer. If I'm a manufacturing company and most of my payments should be coming in through the lockbox and I'm paying things out by paper check, that doesn't really make too much sense that I'm doing that much in funds transfer. So we need to get into what we're buying and ask ourselves, does that make sense? Now, if you look at the 5 pie charts underneath that one that break it out for this sample company by each of their 5 banks, there's a lot more information embedded here. Who has what service? When we show these reports to some of our bank customers as we're helping them manage their analyses and manage their bank relationships more effectively, one of the first things they often say is, wow, I didn't know that's where we were buying those services. I didn't know that. So you look here, and at the first 2 banks, they're very pink, okay, which happens to be lockbox. So I've got 2 pretty active lockbox banks. Then my bank in the middle has a lot of yellow and a lot of green, so funds transfer and electronic payments. The 4th bank has a distribution of different services, and the 5th bank on the right, almost all funds transfer. Just a tiny bit of spend in a bunch of other areas. Now, if we laid this out according to the dollar amount I'm spending at each of these banks, my 2 big expense banks are the 3rd bank and the 5th bank. So, okay, that's in line with spending a lot of money on funds transfer, but surprisingly, my lockbox banks are not really where I'm spending a lot of money. So as you look at information like this, if you can imagine getting reports like this that roll up your spend into product family levels and let you see things at an aggregate altitude, you can be saying to yourself, is this split the way I think it should be? Why is there so much volume of one type at one bank but not in another bank? What would this look like if instead of 5 banks, I had 4 banks and I took out one of the banks where I'm not spending very much money and reallocated those services? Or another way of thinking of it is there one bank in this group that I could have a conversation with and say, can you step up your game? What can you offer me so I can give you some more business? And maybe I can make my own life easier by only having 4 operating banks instead of 5. Anyway, you can ask all those questions if you have good data like this.
Well, you know, and the miracle is that you can get these charts out of those reams and reams of account analysis files that you get from your banks.
That's right. These charts that we're showing you are all produced by the in-depth product that we're going to make you an offer for at the end of the session.
So, Kathy, one of the things that many of our Treasury Strategies clients try to do in managing their bank relationships is to allocate their service spend and their balances across their banks in some strategic way, in many cases to correspond with their credit wallet. And so what NDepth shows here is the actual, across each of the banks, the credit share, the services share, and the collected balance share. This is important to the banks as well, because the banks who are lending you part of their balance sheet, extending you credit, expect services or balances in return so that they can get an appropriate rate of return. And in fact, this is a great chart just to have in a discussion with your bankers and adds transparency to the relationship. On these charts, you can see the blue shows the credit share of wallet at each bank. The gold shows the service charge share, and the red shows the collected balances. If we look at Mustang Bank in the middle, we see that even though it only has a 10% share of the credit wallet, it has 40% of the services. Now, many of our clients might ask, well, do we really want to have 40% of our services at a bank that is only providing 10% of our credit? And obviously, that's a basis for a very productive conversation between you and your bank. 25% of the balances are also at Mustang Bank. So without extending much of its balance sheet, Mustang Bank is getting an outsized share of your service charges and your balances. On the other hand, Tri-Central has 40% of your credit. They're extending their balance sheet to you, but are only providing 8% of your services. Again, is that the balance you want? So many of our clients use this to try to be more productive in the way they manage relationships.
I think it's important to note that as you're the person in charge of looking at account analyses, thinking about how you're spending your service dollars, you also need to understand from your senior financial management what their philosophy is about allocating business to these credit relationships. This isn't, you know, changing the amount of service business at Tri-Central Bank isn't a unilateral decision that any one of us could probably make. We'd probably want to have some discussions inside Treasury about that. But if you can imagine having had those discussions and said, hey, look at these guys, they're giving us 40% of our credit. They're getting very little of our services business. Should we go to them and ask them, can they step up their game? Do they have ideas for improving the business they can do with us? What can they put on the table that would be interesting to us as an opportunity to get more of our services share? I think that would be a really good discussion.
Yes, it would. And then we can get to the next page. This in-depth report is the monthly variance report. I know it's hard to read here. You'll all receive a copy of this deck, by the way. But what these reports allow you to do is manage your spend by product family. And it allows you to see sort of the all-in cost within a product family. In addition to that, it shows variances in prices and in volumes and in total spend from one month to the next. This shows you where there might be issues, might help you identify some possible causes there. So if you look at the report, you can see we're showing two product families here at Heritage Bank, depository services and account reconcilement services. Those would be at the product family level, and then at the detailed line item level, and this is all the stuff that you get on your hundreds of pages of account analyses, you get to see the detail, and a couple of things will jump out. Our clients will learn, for example, that last item line under deposit services is the deposit coverage charge. Now, some banks call this regulatory recoupment, some call it balance administration fee, but that's basically the charge for holding balances at your bank, and in this case, our sample client is actually paying $8,300 a month simply as a balance deposit charge. Many of our clients, when they see this, actually aren't quite aware of what that is, and may be in a position to do something about that. When we look down at account reconcilement services, this shows you the importance of looking at the entire product family. Because when you buy account reconcilement, there are maintenance charges, per item charges, information charges, reporting charges, stop payment charges, the whole ball of wax. Now, if you look at the second line, there's the full positive pay per item, 7,500 items at 8 cents. And many of our clients say, hey, that's a good deal. We got 8 cents an item. But when, in fact, you look at these, there's also the stop pay and the maintenance charges and whatever. So the total charge to process those 7,500 items is $4,500, which is an all-in price of 60 cents an item. That's not a number that you see on your account analysis statement. That is a number that in-depth will show you. And if those numbers seem out of line to you, you may find, you may look at the individual line items and ask yourself whether you need all that reporting or whether you should have more reporting. Or you could consolidate accounts so you have fewer maintenance charges. A lot of our clients get a lot of ideas on this page. When you look over to the far right, you can see in the green and the red positive and negative variances. The big item here is the $1,000 negative variance in checks return charges, and when you investigate, you see at $25 a piece, they went from 4 items last month to 47 items this month. So you might ask yourself, did something happen in one of the businesses that caused more return items and caused you to spend an extra $1,000? Again, great insights here. The next page helps us untangle the earnings credit rates. Earnings credit rates is a fee offset that your banks provide against collected balances, but your banks also charge an assessment fee against ledger balances, and it's important to look at the two of them together. And what we see in the report at the bottom here, the ECR overview, shows that the earnings credits across each of the banks and the balance fees across each of the banks. And at the bottom, we turn those into rates. And this is really where the rubber meets the road. You can see at Western First Bank, where there's $6 million on deposit, the all-in effective rate is 43 basis points. That's a 60 basis points earnings credit rate minus a 17 basis point balance assessment rate. If you look at the second bank, First Digital, where there's only $800,000 on deposit, the net effective rate is minus 68 basis points. And I have to tell you, we are amazed every month at the number of our clients whose net effective rates are negative. It's a surprising number, and it happens in this case because First Digital is paying a 30 basis point earnings credit rate. While not high, it's not the lowest we see, but the balanced assessment rate is effectively 98 basis points against collected balances. The reason that's so high is this is a lockbox bank. There's a lot of float in the account, and the balanced assessment fee is assessed against float as well as collected balances. And when you put it all together, lo and behold, you're paying 68 basis points to hold your balances there. Now, when rates rise, these numbers could get much bigger, so it's really important now to get a handle on these. The final in-depth report we'd like to show you that our clients really find useful are the benchmarks. You know, are the prices you're paying too high, too low, or just about right? You know, and you have to ask the question, are benchmarks useful? You know, on that prior report, if you looked at the 8-cent account reconcilement per item charge, that's what most companies will compare. It's, you know, it's the one thing that's sort of apples to apples across banks. So this bank is at 8 cents, another bank is at 9 cents or 12 cents or whatever. But in fact, as we showed you, the all-in cost there was 60 cents. So generally, when our clients compare against benchmarks, what they're actually seeing says more about the way they've structured their services at the bank and opportunities for savings or improvement through that structure rather than renegotiating bank prices, which actually turn out to be a very small part of the equation. So it's the all-in that's relevant. What's really important, though, and you can see in the chart on the right, the price is not a point. The price isn't X cents or X dollars per item. As we see across our database, which now has almost 1 million line items in it from our in-depth customers, it's a continuum. And for most product lines, it's a volume-driven scale. If you look at this lockbox chart, at 100 items per month, the top end of the range is about $10 an item, and the low end of the range is about $5 an item. At 1,000 items a month, the top end of the range is more like $4.75, and the bottom is $2.25. So, you know, if you buy one of these services that says the average lockbox price is X, that's really nonsense because it's really based on the volume and based on the services you use at the bank. On this particular in-depth chart, we see the high end of the range, the low end of the range, and the median. It's interesting, the highest number would be that diamond. You know, the 3 diamonds are the 3 lockbox banks that our demo clients are using here. And the leftmost, at a volume of about 600, is $4 an item, which is the highest of all 3 of the diamonds. Yet, on a volume basis, it's actually below the median price for that volume, whereas the other 2 banks, even though the price is lower, are above the median based on those volumes. So, you know, this shows you opportunities perhaps to take advantage of scale by combining services, though we're doing it 2 or 3 banks and bringing them down to 1. And, you know, that's really why you use benchmarks, not to, you know, fight with your bank over 3 cents an item or something. You know, it's really much more material than that.
Okay, so let's ask the question again.
So let's ask the question one more time. Why bother with account analyses? Absolutely, check prices and balances. But there is so much more that you can do with these. You can maximize how you're deploying your excess funds. Maybe you can negotiate better rates, and with analyses like we've just showed you, you'll be able to see clearly what the opportunities for that might be. Maybe you can move your balances to banks that have a much more attractive net effective ECR as opposed to just the highest ECR. Because once you get those balance assessment fees factored in, things can go negative pretty quickly. You can also think about how you're allocating your wallet for maximum effect among your relationship banks. You could think about making sure your credit banks are getting a fair share of your business. Maybe giving important credit banks an opportunity to step up and take a bigger share. You can have much more meaningful discussions with your relationship banks. Tony's just talking about benchmarks. Well, those lockbox banks, you could have a pretty interesting discussion about whether there might be opportunities to have some price improvements if you could consolidate some of that volume and what those opportunities might be. You can talk to your banks about ideas they have for making your cash management easier or better ideas to bring into your service mix. And how to solve problems that you might have. If you've got this doing way too many funds transfers kind of issue that this sample company seems to, hey, that can factor into your bank relationship discussions. How can we stop doing so many funds transfers? What's a good way to do that?
Or maybe go to ACH, you know?
What do you know? So anyway, a starting point for good relationship management. Okay, the offer. And by the way, let me remind you, be typing your questions into the bottom right-hand corner because we're about to start Q&A. The offer, our new product delivered completely without installed software through the portal is going to be available to companies who sign up for it by the end of this year, by December 31st, for a free one-year subscription. Absolutely no obligation. And it will handle up to 5 supported banks. And I've got a little box there that shows the 50-some banks that we're supporting currently, which are the largest treasury management banks in the U.S. All you have to do to use NDepth and get reports that are like the ones we've shown you in the charts today is submit your PDFs or your 822 account analyses every month. And we suggest that you would start that in December of this year with December's analysis, because then if there are changes that come to your prices in the first quarter of 2018, we'll be able to catch those in the variance analyses. And we've given you the address there for the sign-up form for the product, but I also just want to say if you go to our website, treasurystrategies.com/indepth, you'll also come to an information page about NDepth that gives you frequently asked questions, that gives you a whole deck of sample reports, more information for you to peruse. So sign up by the end of the year, get 1 year completely free. There is no obligation that you would continue after your free year, although we think people are really going to want to because it is such a good product. It saves you so much time. Basically, you upload and then you download, and you get beautiful reports of the type that we've illustrated here. Also, we'll say, hey, if you only have one bank, you can still use NDepth. It's not just for companies with lots and lots of banks, because even just with one bank, you'd benefit from having those product family roll-ups and being able to track everything on a year-to-date basis. Beautiful reports without hardly any effort whatsoever.
Well,
okay.
And for just one bank, you're still making sense of the pages and pages of analysis information, and frankly, the reports come out in English so that your CFO can read these and understand what it is you're doing and spending so much of your value-added time on. Kathy, actually, that was one of our questions. Another question is, what will it cost after the free trial period is over? So we're talking about a 1-year free trial, and there is no obligation to continue after that.
So after 1 year, the pricing for our NDepth Basic product, which covers up to 5 banks, is going to be $250 a month. So for about $3,000 a year, you can use this product every single month and get the benefit from it. And we figure that virtually every company is going to find at least $3,000 worth of benefit,
yeah,
probably
like
10 times
a 3-day payback period.
Yes, yes. And then we'll also have a more robust version, which we call NDepth Pro, that's going to be $1,500 a month.
But that's after the first full free year, and there's no obligation.
Right.
Okay. So let's talk a second. There's some questions about data privacy. So, Kathy, who can see my data?
Oh, nobody. Nobody can see your individual data except for you. We do aggregate data for benchmarking purposes. So again, even if you only have one bank, you're going to be able to see the benchmarks, but you won't be able to see anybody else's individual data. We reverse engineer, we craft these benchmarks in such a way that it is utterly impossible to reverse engineer them and see anybody's individual data. So your data is completely protected.
So when I upload these reports into the portal, my analysis statements, how long does it take until I get my reports back?
That's a good question. Right now it takes about a month. So if you were to upload reports today, it's December 12th, you'd have your reports shortly after the first of the year. We're working also on accelerating some of these processes, and we expect that fairly soon it will be just a matter of days once you've uploaded.
Kathy, how many companies are currently using NDepth?
As of today, we have 90 customers using NDepth, and we're adding more every week.
That sounds pretty good. Are we seeing any preferential pricing for different segments, not-for-profit segments, either lower assessment fees or better earnings credit rates?
You know, as we are starting to look at these comparative data points, it is so hard to tell whether there actually is segment-level preferential pricing or not. You know, people's packages of services that they buy turn out to be very, very different from company to company. And we also see at some banks that different segments are on different account analysis systems, so they have different price schedules.
Actually, different product names.
Different service codes. I mean, there is so much difference here. We're thinking that the best way to look at your prices is to use these benchmarks that we've talked about, because they factor in all the other services that you're buying. They let you look at the impact of volume on pricing, which is probably the biggest determinant of the price you're going to pay is your volume.
I will add as a final point, we saw a new line item on a major bank's account analysis just within the last month called Hurricane Harvey Relief. And it's actually a rebate that this bank is giving clients in the Houston area or in the southeast Texas area who've obviously suffered through Hurricane Harvey. And it is a line item with an AFP code, believe it or not, with a whole bunch of nines in it. But you know, it's kind of interesting what we're learning with this stuff. So, and we'd love to have you join our network currently at 90 banks.
So thank you for joining us today. When we close the webinar screens, the screen that comes up will direct you to our website, which, as I said, is a place that you can look at frequently asked questions or see some demo reports for NDepth. We'd love to have you as a customer. And again, thank you for joining this afternoon.